Everyone. Good morning, everyone, and welcome to Tuesday, the 8th of September, 2015. I'm Greg McKenna, so let's go around the ground and see what happened in markets overnight. Of course, the US Labor Day holiday in the US robbed traders of many of the catalysts that we're normally used to, but that was nice for a change with markets being fairly quiet. That is, unless you're an oil trader, and Russia decided they weren't going to join OPEC in cutting. That's what Imre Speiser from Westpac Wellington said. And of course, we saw prices off close to 4% overnight. That hurt the Canadian dollar, which is back up at 133 this morning. And any notion that I had that the CAD might be bottoming and perhaps strengthening against US dollars seemed to be going out the window. I haven't been stopped out on my small short on dollar CAD yet, but it looks like it's getting close. The absence of any catalyst also let some of the moves shift about. Dollar yen's back above 119. But I guess the key thing is that today in China we have the release of the trade data. After non-farm payrolls, Chinese trade has been elevated to probably the most important piece of data on the planet each month. One of the reasons, of course, is that everyone's interested in what is happening with China exports, so what the demand from the rest of the world is going to be, and what's happening with China imports, what China itself is doing and how it might be going. And the combination of those two factors have been driving sentiment towards China. It was just last month when the Chinese trade data surprised everybody with a big fall in exports that we really did start to kick off these concerns about China. So 12 o'clock today, Australian time, Sydney time, we'll be watching the release of that data very closely. And the market is expecting that things are going to continue to be weak. If I look to Europe last night, they opened higher than where they closed, so they struggled to keep up with some of the early gains. A lot of that, I guess, is just because the States wasn't there and they don't want to get too excited. Of course, part of it was that there was a poor lead given to European traders from China, from Asia. The Nikkei did okay. It was up around 0.3% or so, but the Shanghai Composite ended up down 2.5% after being up 2% at one stage. That kept the Aussie market in the red, and the energy sector under pressure again today. Might have it there further, but it's really going to depend on Chinese data. Of course, today we get Lucy Ellis, who's the head of the Financial Stability Department at the RBA, talking at 9:05, which is why I've done this a little bit early today. And she'll be talking about housing and what we've learned about financial stability. That's going to be an interesting one. Plenty for the bankers and the boffins to discuss. And then at 11:30 we get the NAB business survey. I'm a bit worried about the business survey in the context of what's happened over the last month and where the overall outlook for the economy is. Last month we saw a pullback in the strength the previous month, but we also saw a big drop in New South Wales, and it's New South Wales and Victoria that I'll be focusing on 11:30 today to see how conditions and how confidence is going, because we need confidence to be strong and we need conditions to be solid if we're going to get business to invest in Australia rather than just run out to Harvey Norman or JB Hi-Fi and purchase TVs or computers or stuff that could be depreciable, because that's what we saw last week with the release of the July retail trade. They disappointed. Now, if you average out the 2 months, 0.9 and negative 0.1, you've got 2.4s. So that's not terrible. If you had a print of 0.4 and 0.4, we'd probably still be saying things are okay. So the jury's still out, and it's way too early to get overly bearish. But we'll be certainly looking at the NAB business survey closely today. Elsewhere, a couple of things. When I did my charts yesterday for the Go Markets Asian Trading Wrap, I had a look at the Aussie and the ASX, and what I thought was that perhaps we are starting to see some basing here. Now, the way I normally trade, I've got these two moving averages, my 15 and my 30. I've got my Bollinger Bands. When we get outside the Bollinger Bands like we did here, you normally get some sort of a recovery. It's not often sustainable, but you do get a trading opportunity here, and you head back towards my fast moving average. We've got the Aussie down once again at or below the Bollinger Band. All that says is the market's getting a little bit ahead of itself. If you look at the way the Bollinger Bands have opened up, you can see that the breadth is normally associated to. We've had an expansion here, and the market went sideways for a bit. So I'm thinking that maybe the Aussie can find our level. Now, obviously, that's dangerous. We've had one day the States without that sort of thing. It's a dangerous assumption to make, but it's not really an assumption. So I'm looking for one more day to see if I can't get a catalyst for a rally. Yesterday, I said I thought that I was looking to buy, and that's certainly the case. Likewise, in the ASX, the Aus 200, it's not really a base, is it? It's that yesterday's low was lower than the previous day's low, which was lower than the low of last week. And we still haven't got down to the 4,800 level, which is where the medium-term support is. But depending on what happens in the States tonight, there are some tentative signs that the ASX 200 market is trying to bottom. That's one I don't want to catch in terms of a falling knife at the moment, because overall I'm bearish on stocks. So my view would be any rallies are rallies to sell. But it's not beyond the realms of possibility that you couldn't see a rally back towards sort of 51.40. So, 120 or 130 points from where we are right at the moment. So that screen sharing stop. Right. So that kind of colours my outlook, and perhaps the question that I ask myself is the bearishness that we've been seeing in markets, the bearishness that has been all pervasive, is that something that really has got ahead of itself? That's the big question. And I guess the answer to that is neatly encapsulated in some data that Deutsche Bank released last night. Jim Reed, Nick Burns and Seb Baker put together their long-term asset return study. It's taken them a few months to put this together, and it's really just a summary of where asset markets are, whether they are stock markets, bond markets, or housing markets. They've looked at the separate markets individually. They have put them together in an index, and what they have found is that markets are as stretched as they have ever been. As stretched as they were in 2007, as stretched as they were in 2000. And so you can see here that if you put the three together, we are at peak valuations. Certainly bonds, we know bonds are at peak valuation. Equities are pretty expensive too. Even the key about their analysis was even after the recent sell-off, asset markets are overvalued. Now, what that means is that the Fed really is going to be an important part of what's going on, because they do say that, we all know overvaluation can persist as overvaluation for as long as it wants. That's been the case for quite a while now in markets because of what central banks have been doing. And largely that's the paradigm shift or an uptick in inflation that they'd be looking for if there was going to be a big turn in assets. So markets are right to be wary of the Fed. So we'll have to see how that plays out in the in the next week or so. Otherwise, Chinese reserve data yesterday. I don't understand why the Chinese are supporting their currency when they should just let it go. All they are doing is buying whatever foreigners want to sell. There's already a capital flight. We know that. It doesn't mean that they have to float the RMB. They could simply just let it devalue and let the market clear. Or I'm not sure. We've seen with these fixed pegs that they're either fixed or floating. The middle ground always costs the central authorities money, and that's what it's cost them last month. 94 billion, I think it was, in decline in Chinese reserve assets. That's just a wealth transfer from the Chinese people to the rest of the world, which is, to me, seems silly after all the work they've done. And they've got their training wheels on when it comes to running markets and that sort of stuff. But they're no different to where we were 30 years ago when we were learning about how to float the Aussie and that kind of stuff. So I'm not going to bash up the Chinese for what I think is, a valiant effort to try and bring order to markets, which is, as anybody knows, really impossible. Anyway, to the day ahead, we've talked about the Chinese data. Keep an eye on that at 12 o'clock. Lucy Ellis is going to be interesting for banking more than anything, so that might impact on the bank stocks, the big four, Bendigo, Adelaide, Suncorp, all the listed entities, Bank of Queensland, of course. Then 11:30, we've got NAB Business Survey. Have a look at Business Insider for what I write about that. And then, of course, at 12 o'clock, David Scutt from Business Insider is going to be covering the Chinese data. German trade tonight is interesting, and then we have another Fed speaker. But realistically, it's asset price moves tonight that are going to be the most important thing over the next 24 hours after Chinese trade. But Chinese trade is going to be huge. That's really going to set the scene as we head into Europe. Set the scene for the Aussie dollar. I could get blown up at 12 o'clock if that data's weak. But then again, it could be massaged. So it's going to be another fun day. After a quiet start to the week, we're back into it. Plenty of data in Australia, plenty of action in China, and then of course the US markets get to come back and catch up. So that's it from me. I'm Greg McKenna, and I'll see you tomorrow morning around 9 o'clock. All the best and good trading. Bye for now.